Hi again, this is Jim Koch, the balance sheet guy over at the Informed Household. Today we're going to talk about why investment fees matter, a deep space journey. But before we get started, please read these important presentation disclosure. Okay, with investments, there's kind of four big buckets of fees we're going to look at. The advisor fees is if you have a professionally managed portfolio. Usually they base the fee on what they call assets under management, AUM. I'm sure you've probably heard that acronym before. You can get charged a flat fee. And what we're trying to come up is what is that annualized rate. So it could be pretty high, like over 2% roughly a year on whatever that balance is, but you also might be getting full financial planning services, or it could be low, 0.25 or lower if you're just using a robo portfolio management tool where all they're doing is investment management. The next bucket is fund fees. So that's how much internally fees that you don't necessarily see, but you're getting charged for owning, like mutual funds or ETF, exchange traded funds. And you'll usually see that called an expense ratio, and that's an annualized rate. So here's some examples here off to the right. That could be if you're doing individual stocks, it's pretty much zero, although there's some other soft costs in there. If you're using very expensive actively managed funds, it could be pretty high. It could be 1.5%. So what I'm trying to do is get all these rates in an annualized bit, so we can add them all up and get an idea. It's not going to be exact, but an idea of what you're paying on an ongoing rate that's coming out of your portfolio, basically. Then there's the big transition costs. These are the hardest ones to monitor because so many of them there's direct and indirect ones. But this is any time a transaction occurs. The most typical is trading costs. A lot of times you get a commission, but sometimes there is no commission with certain custodians and stuff. And then there's softer costs like the bid-ask spread. If you have a mutual fund or an ETF or stock that just isn't very liquid, the difference between the bid and the ask can cause you some leakage of some returns and stuff, both on the buying and the selling side. So I can't say it's zero. It's not totally frictionless. Somewhere in there's some transaction costs. And then the biggie is probably the tax drag from when you actually go to realize a gain or collect dividends, or even if it's coming out of your IRA, it's coming out as ordinary income. So there's all these different tax rates that can hit on it, and those can be big. I mean, they can be very little if you're not reporting much income, but they also can be extremely high, and that really affects your take-home pay. So if you don't believe me on the taxes side, here's a good little exercise you can do is if you have a Roth IRA or an HSA or something like that, take that account balance and multiply it by 1.33, which I'm just saying is kind of a generic effective tax rate you have, and that's the after-tax equivalent of that value of that particular account, an HSA or a Roth IRA, versus a taxable account or a regular traditional IRA or wherever, where when you take monies out of it, they're going to be taxed in the case of an IRA at ordinary income rates. So that's kind of the magic behind the tax-free distributions of Roths and HSA and why they're so valuable, because the tax equivalent balance is not just what's reported on your statement. It's much higher because it saves you from having to pay taxes when it comes out. Okay, I created a little tool here. We're going to demonstrate how these taxes impact you. Again, what we're really looking at is the three that affect just your portfolio before you sell anything, and they're collectively known as the fee drag. So this tool over here on the right is what I call the portfolio cost analyzer, and it's an old tool I created a long time ago, but it's kind of a good one to visually see how these fees affect the long-term performance of your portfolio. So let's get started. Okay, so here's the portfolio cost analyzer app. It's a little Flash-based tool I developed a long time ago, but it's good for demonstrating stuff like this. So let's look at the top section here. Let's say you have an initial investment of $500,000. Let's just say you're going to, every time I click up and down, I get a different run over a 20-year period. Here's a good one. I'm just going to freeze this so we can work with the second part of this. So without any fees or anything, this top graph is what your returns would possibly look like over a 20-year horizon if you're primarily in a stock portfolio. But now this middle section shows all the different fees that start reducing that return. So, and they're controlled by these three main fee buckets that we just discussed: advisor fees in green, fund fees in orange, and these transaction costs in purple. So let's just take a typical an advisor or something. Let's say it's charging about 1%. So you can see I'm moving the dial and it's changing the cost graph in the middle. So I'm trying to get it about close to 1%. Let's say you're using some active funds, hopefully some index funds, then it would be really inexpensive. But let's say your average here is about 1% too. Transaction costs are a little trickier because they're hard to estimate and get them into an annual rate equivalent. But let's just say typically here 20% is getting lost through trading activities. If you're trading a lot, you're going to have high turnover. There's going to be more fees versus if you're buy and hold and maybe just rebalancing once a year. Also, I should say a lot of these transaction fees also happen inside the funds themselves. If you own ETFs or mutual funds, and it's hard to capture those. You can't directly do, but they're reflected in obviously a less return that you get from the mutual fund. So we can't capture everything, but we're trying to get close. So what's interesting, if you look what I have here, if we add up all the fees together, you can see it's about 2.3%. And then I did a kind of fun what if question. What if we could reinvest those fees coming out of what started out as a $500,000 portfolio and get 5%? And this is the opportunity cost, which is almost 1.5 million over that 20-year period of having 2.23%, leaked out of your portfolio over time. That's huge, and that's really expensive. And you can see even from the middle graph, it starts out at about 15,000, but by the time you get to year 20, fees alone for that year are taken out about 100,000. Now, granted, that's on a $4 million portfolio if it truly grows that much, but it's still, fees matter a lot. And the sad thing of all this too is we haven't even accounted for taxes. So if you live in a high tax state and you have high income, over 50% of that return, if it's coming out of an account that's getting taxed as ordinary income like an IRA, half of it's going to go to pay taxes. So this stuff really adds up and adds up quickly. So this is why we think of your fees as basically, it's your personal black hole. Once the fees are incurred, your portfolio returns are reduced and there's no going back. You can't get those fees back. Okay, so this is where the anatomy part of the presentation kicks in, and I do my best to channel my P's anger translator riff. So I love this graphic here, and I apologize I don't have the source for it. If somebody tells me where I got this or can do that, I'm happy to source it. But it explains basically the anatomy of a black hole, and that's what we're referring to in terms of the fees. So the first one to look at is singularity. That's the very center. That's where all matter and stuff gets collected in and disappears, and you can't see it. And what we say is that's really how, unfortunately, a lot of people operate in the U.S. regarding their portfolios. They have no idea how much they're paying in fees and stuff and how that is impacting their returns, which is kind of sad. Then the next metaphor here is the event horizon, which from the picture on the right is the black spear. So that's what they call is the point of no return. Once you get in there, there's no turning back. The black hole is going to suck you down. But for us in investment land, we view that as, that's the problem of ever compounding fees negatively. You've heard about compounding fees or compounding returns being a great thing, but there's also negative compounding when it comes to fees, and that's why if this stuff is left untreated and goes on, it can just really dent your returns to the final one here, the relativistic jet, which is that little spew you're seeing going out of the middle of that of all the consumed matter and stuff being thrown back out. But we think of it as, you screaming or hurling at the realization that your portfolio growth prospects have just, got hammered, and you may not be retiring when you think you are. Okay, what can you do at home? Well, if you have an advisor, ask your advisor what your annual fee drag is on all your accounts, and they should be able to come up with a pretty good number. It's not easy to get, but it's doable, and it's a way you can stay informed. And it's the most important thing. It's your money, and it's such a straightforward way that you can save from just mindless fees and stuff. So get an idea where it is, and I don't know is not the right answer. This is something personally I believe in. This is my opinion, but I don't like taking fees from, and I do this on the co-capital side. This is not the informed household speaking here, but in my practice, and I think it's a good one, when you take fee distributions directly on an account by account, that means you're charging based on AUM, assets under management. You can take the total fees from a single account, and I think it's better to take it from a taxable account, like a checking account, because I don't want anything extra to have to come out of a important retirement account, because you're just so limited on you can only make such level of contributions to an IRA, and you can only do it for a finite amount of time. I don't want anything leaking out of that. So that's something too that you can ask your advisor is, please don't auto deduct from IRA accounts. Just, I'll pay you out from another account if they're doing that. And then the other thing that I would do or recommend is estimate your marginal and your effective tax rates. You should have an idea of what those are. So an effective tax rate is basically, what, after all deductions, everything's you're taking, what's that a rate that you ended up paying, for any given year. And then the marginal rate is there to help control your brackets and stuff. I've got a little diagram I'm going to show you in a minute, but the reason why that's important is, we have this crazy tax system where a lot of assets get taxed based on income streams, and that includes, unfortunately, in my opinion, a lot of financial assets, especially when they've grown. And it just depends on what type of account you have them in. So if you got portfolios in IRAs or 401ks, when those come out, those get taxed as ordinary income, so it's based on income level. Capital gains get taxed at a lower rate, but it's still based on a level of income coming out. And then there's qualified dividends in some cases, and other cases they're not qualified. So there's all this craziness, and you need to know what's in what account and what it's being taxed at. Hope you like this. Please try to subscribe to the Informed Household. If you go to our sign up, it'll look like this. And please sign up, give it a try. It's free for 30 days. We have a lot more presentations and stuff like that. The other thing is, if you do subscribe, and request it if you email me. I'm happy to send you, this is a graphic I use. This is one specifically for California, but talk about some of the key tax brackets and rates and how things get taxed, especially from your portfolio accounts. And I'm happy to send this to you. Also, if you sign up, I'm fine. I can send you a link to the Swift file to run this yourself. Just a quick note on the PCA. It is written in an older Flash format, and that doesn't run on most current browsers. But if you do have an old version of IE, Internet Explorer, it will run inside of that. So I'm wrapping it up. That's it for me. I hope you enjoyed the black hole metaphor, and as Albert Einstein describes it, it's where God is divided by zero. Take care.